together for advisor, author, radio show host, and CEO of APO Financial, John Dinnr.
Thank you, Emma. So the scariest moment of my life happened about 16 years ago on Hilton Head Island in South Carolina. Anybody ever been there? Nobody's been to Hilton Head? Oh my goodness. Well, you should go. It's a beautiful place. So you can kind of tell I'm not from around here originally because I talk kind of funny. I'm from Kentucky originally. I've been here 31 years, so this is home. But 16 years ago, I took my family, my kids, to Hilton Head. And we rented a house that was about 5 minutes from the beach. And on Hilton Head, all the developments are called plantations. And the best way to get around on a plantation is with a bicycle. So, but this house came with bicycles, but we got there like late Saturday, so we waited till the next morning. Everybody woke up. We all found a bicycle. Caitlin was my oldest at the time, 20 years old. Matthew was with us, my 13-year-old. Mackenzie was 11, and my 3-year-old son, Skylar. And so he was almost 3. So the next morning, we all woke up, and we found the bicycles. I found the bicycle with a little seat on the back, and I found one of those little helmets that you put on little kids. And I got that helmet on him, put him in the seat, and we take off to the beach. Now, I've told this story, I don't know how many times in the past 18 years that I've been doing this. And my wife and I were rummaging through some boxes trying to get rid of some stuff, about 6 months ago. And we found some old pictures. This is a real picture of Skylar and I on that bicycle. We were in front of the house we rented. Sky, he was almost 3 then. He's changed a bit. I haven't changed at all. I'm still bald, so I can't help that. But we take off, we go to the beach. We get there, my daughter, Caitlin, tells me that I forgot the suntan lotion. So I go take Skylar, we go back to the house. I pull up beside the house, go in the backyard, take him out of that seat, take that little helmet off, put him in the grass, and I run inside. I was not gone more than 30 seconds to get the suntan lotion. I grabbed it, came back out to go pick him up, and he's gone. And this house, about where that tree line is out there from where I'm standing right now, also came with a pool, and my little 3-year-old Skylar was face down in 8 feet of water. So I take off running. I've got my cell phone in my pocket, my keys in my pocket, who cares? So I jump in the water. Of course, I go down before I go up. And I'm in that water, and the only thing I'm thinking is I'm praying to God He lets the little boy be okay. It's the only thing I care about. And so I finally get to the bottom, push myself up. I get enough leverage to push him out of the pool, but I go back down. I felt like an eternity in that water. And the whole time I'm just praying to God, just let my little boy be okay. That's really all I want. I got up there and I grabbed him, I rolled him over, and he's laughing at me. He goes, "Dad, let's do that again." I don't know if you've ever had a full body adrenaline rush, but it feels like acid under every part of your skin. I was sick for a week. The whole week we were there, I couldn't eat. I had nightmares. We got back home. It took me about 2 years, just not have a lot of PTSD about it. Like I've said, I've told this story a whole bunch of times in the last 18 years. I can tell you even now, I can feel my hairs kind of starting to stand up because I could have lost my little boy now. Now, he was fine. He's about this tall. He just got back from his first year in college about last Saturday. He's doing great. He's got size 12 shoes. And he's actually my very, very best perfect child of all my children. So why do I tell that story to people that come and talk to us about retirement planning? Because the only thing we do is comprehensive retirement planning. It's because I've got a bunch of advisors that work for me. I've got multiple offices. We've met with thousands of people over the years. And everybody either gets around to asking this question or we get it out of them because I know it's in their heads. It's in everybody's head. The number one question is kind of the number one question of all of retirement planning is this one. Are you going to be okay? That's what all my clients want to know. We help them answer this question with certainty. And if you can't answer this question with certainty going into or in retirement, that's a problem. And so tonight I'm going to kind of show you how we do that for our clients. Now, this is our retirement process. We call it the PRIME process. It is a comprehensive retirement planning model. where I got this from, I used to practice law. I used to be a securities attorney. Before I ever started any of this, I went to the top 15 research institutions in the United States. I've been doing retirement research for 70 plus years. And I asked, queried their systems. The first question I asked, I said, what are all the risks that research has identified in America about retirement in 70 plus years of research? 15 institutions. We got massive amounts of data back. We took that data, we parsed it all out. It was a team of 7 people. It took about 8 months. It fell in these 5 areas. This is the most comprehensive model as a risk management tool for retirement planning. So back when I practiced law, I bought and sold 3,000 businesses. They were all risk management exercises. So I just approach this as risk management. Let's lower or eliminate all the risks we can in retirement. So we're going to talk about each one of these 5 areas tonight. But we're going to start someplace first, because I think this is the starting point. So in the financial world, there are only 2 standards of care from a professional to you as a client. You have a fiduciary standard of care, or you have a suitability standard of care. So every attorney in the United States, everyone, it has a pure fiduciary obligation standard of care to their client. So it's the highest duty of care anybody can have to anybody else. So I practiced law. I was really used to being a pure fiduciary. So a pure fiduciary can't hide things from you, can't not tell you things, can't do things that you don't approve. And if they do, you can nail them to the wall and go after their professional liability insurance. So when I got started in this business, I was a little surprised of what I'm getting ready to tell you, because I really didn't think it was this way. Even though I was a securities attorney, only 2% of firms, actually less than 2% of firms and financial advisors in the United States operate under a pure fiduciary standard. 98% plus operate under a suitability standard of care. To this day, I still don't understand that, how they make all the lawyers be pure fiduciaries. They don't make people who handle people's money pure fiduciaries. I still don't get that one, because my firm is in that less than 2%. We are a pure fiduciary firm. Suitability firm, investments, recommendations, they only have to be suitable for you based on who you are, where you're at, and your education, your experience, your assets, all of that type of stuff. Because the duty of care legally is to the firm, not to the client. So if you've ever opened a brokerage account, for example, with one of these firms, all the big name firms, you fill out a bunch of forms. One of the forms you filled out is called a suitability form. That form asks you questions like, what have you invested in the past? How much money do you have? What type of accounts is it located in? What's your income? What's your education experience? All those types of things. That suitability form is going to grade you on a 0 to 100 point scale. So let's say that you're a 50. You just grade out at a 50, so you're right in the middle. Let's say you're working with a suitability firm. They got a lot of stuff they can put in your portfolios and do for you, but you're a 50. You're right in the middle. So the things on this end and the things on this end are not suitable for you by definition. So you will never see those things. Still plenty of stuff in the middle, but right there, they have met their duty of care to you, because anything else they put in there is going to be for one purpose only, and that is how much money can the firm make, usually with a lot of non-disclosed fees and expenses, because they can do that in the suitability world. A pure fiduciary can't do that. So my little example is, if you went to a suitability firm and you were trying to accomplish something, either a goal or take care of a problem, you're going to fill out that form, and they're going to put that form in the computer, and the computer's going to pop out Fund A. And you're going to look at Fund A turned upside down, right side up, and guess what? It sure looks like it takes care of what you're trying to do. So that goes in your portfolio. You go home happy. If you came to me in the fiduciary world, we don't use suitability forms, but we get to know our clients really well. And we don't use a computer to figure out this, but let's say we did. Let's say we put all your information in with the issue you're trying to accomplish, and we put it in there. The funny thing would happen. Fund A will pop out, but then Fund B is going to pop out. And you're going to look at fund A, you're going to look at fund B, you're going to turn both of them upside down, right side up. You're going to find out that they are exactly the same. They do exactly the same thing, except for one thing. What's the difference between A and B? Fees, expenses, how much you pay. And so in my world, if you're in the fiduciary world, and if for some weird reason you wanted to put A with higher fees and expenses into your portfolio, I couldn't do it. Because on its face, it would be a breach of the fiduciary obligation I have for you, because B is less expensive and it does exactly the same thing. That's how the financial world works. So I always like to start here. Now, protecting people's assets. I think this is where retirement should start. Unfortunately, most people don't have much defense in their overall portfolios because they do buy hold investing in general, and so they just go up and down with the market. So when you were working, you had a paycheck, and you probably had, or hopefully, a retirement account or two. And so when you were working, your paycheck covered your expenses, took care of things. You were able to save some money back for retirement, for vacations, to send your kids to college, those type of things. And so when you were working and your retirement accounts went up because the market went up, you were pretty happy about that. But did the fact that your retirement accounts went up affect your lifestyle when you were working? No, you weren't pulling money out, right? So, and when they went down, you weren't very happy about it. But did that affect your lifestyle when you were working? No. However, when you retire and you're pulling money out of those accounts and the markets go down, is it potentially going to affect your lifestyle? Yes, it will. And what you're going to find is everybody in this room, if the markets continue to do what they've done for over 100 years, we will all experience 4 to 5 times more of those big drops. The question is, how long will those drops last once they happen? We've had 4 periods since in the last 100 years, 25 years flat nothing, 17 years flat nothing, 15 years flat nothing. The last one was 11 years flat nothing from 2000 to 2010. So if that kind of stuff happens and the market goes down when you're pulling money out, it takes the markets on average about 6 years to come back to even. But you're never going to come back to even because you've been pulling money out for 6 years. So you'll be here. It's going to happen to you again. And sometimes between the second and third time it happens, there's a realization that's going to happen. More than likely, you're going to say to yourself, uh-oh, I might be in trouble. My accounts are getting kind of low. I don't know how much longer I'm going to live. So guess what? You have 2 choices if you're going to try to fix that problem. 1, go back to work. Is anybody going to hire you? No, maybe 7-Eleven, maybe Walmart, but you're not going to make what you made when you were working. And the next answer that you have is an ugly one. Change your lifestyle when you're retired. And if you've ever seen anybody do that in retirement, it is an ugly sight. You don't want to do that. You can get through all this if you have a proper plan. Most people don't think through this. This is the reason that you need to really be sensitive about big crash markets. So since 1896 is when this actually goes back to. This is the Dow Jones Industrial Average. It was the beginning of our current stock market. So it was created in 1896. A lot of people talk about the S&P 500 index. Well, it wasn't implemented until 1952. A lot of people talk and use the NASDAQ index. It wasn't implemented until the early 70s. So if you're going to look at the markets from a historical perspective, this is what you look at. There's been 23 times since the early 1900s that our stock markets have collapsed and averaged a 37.5% loss. And when you do the math, that's about every 6 years. So if the markets continue to cycle like economies do, we're all going to experience some more of these. And if you don't have a plan to get through these, that's a problem. So this risk, all of these risks these institutions have identified, they all have names. This one is called sequence of return risk. It's a risk about how the sequence of returns you experience during your retirement years. And so I illustrate this with just a little example of Andy and Ann and Bob and Betty. So Andy and Ann and Bob and Betty, they're exactly the same except for one thing. They both start with $500,000. They both need $30,000 a year for the first 10 years of their retirement to fund their retirement. The only difference is Andy and Ann retired in 91. Bob and Betty retired in 2001. So Andy and Ann went first. They were pulling $30,000 a year out. Only started with $500,000. Didn't have any bad returns until late. And so they pulled $300,000 out of an account that started at $500,000. And because of return in 10 years, they have $1.3 million left. Do you think they're worried about their retirement at the end of year 10? No. They got almost 3 times as much they started with. Bob and Betty saw them do it. They said, we're starting at the same place. We need the same money. If they can do it, we can do it. However, they started in 2001. Had bad returns early. Had a bad return down in 2008. But in 10 years, they're down to about $200,000. Do you think they're freaking out? Looking at another 15 to 20 years of their retirement? Of course they are. And the only difference between these two is the sequence in which they experienced returns. It's a crapshoot. And this is what most people do. I will tell you, you don't have to do this. There are a whole lot better ways. Now, for the 4% rule of distribution in retirement. Anybody ever heard of it? Yes. Okay. So the 4% rule of distribution in retirement has a 64% chance of working for you. That's like you get on an airplane out here at DIA tomorrow going to Miami, and you get buckled in, they shut the door, that plane's on the tarmac, and then the captain comes over to the loudspeaker and says, ladies and gentlemen, it's a wonderful day to fly to Miami. There are no thunderstorms in our way, and we have a 64% chance of making it. Are you going to stay on that airplane? No, the captain's not going to stay on that airplane. It's not a rule. They make these things, there's a whole bunch of these things. They make these things sound like a math rule. 2 plus 2 is 4. Well, guess what? 2 plus 2 is always 4, right? 64% chance. So that's a problem. And then, if you ever come and see us, we ask you to bring things. One of the things I used to ask people when I first started, a little over 18 years ago, I asked people to bring this. I stopped asking it really soon after I started. I've never asked for it again. I would ask people to bring me their retirement income plan. Do you know why I stopped asking that question? Because nobody has one. Not nobody, wait a minute. My engineers do. I got a lot of engineers as clients. They have a spreadsheet. God bless them. They got big holes in the spreadsheet, but at least they got something. So now, most people, even my engineers, they're going to have to make some assumptions when they build a retirement income plan. One of the assumptions they're going to make is an average rate of return over the rest of their life, and that's where this 4% rule sometimes comes in. So I'm going to show you just a little math of why maybe that's not a bad idea, because I call that flat planning, and flat planning does not work in the real world. So we're going to go back to A and B. Can anybody not see my board? Everybody good? So A, 5% the first year, 5% the second year, 5% the third year. The average annual rate of return for Fund A is 5%. I'm not going to try to trick you, I promise. I'm not that person. So 5%. Now, B, 30% the first year, that's great. But then we lose 20, and then we do the same as A, 5%. So 30 minus 20 is 10, plus 5 is 15. The average annual rate of return for B is 5%. Same thing, right? Yes, 15 total time divided by 3. That's right. So now, I'm regulated by the Securities and Exchange Commission. The SEC would tell me that the only thing I can tell you about these two different funds as far as their average annual rate of return is over a 3-year period is that they're both 5%. Kind of sounds like they're the same, but they're not the same. And the best way to figure it out is just put dollars in it and do the math. So let's do that. First year, 105,000. Then second year, 110,000. There's a little compounding going on. So 250. And then 115,762.50. I did that in my head real fast. No, I did not. I've done this many times. It's almost $16,000, right? 3 years. Now, B, first year, 130K. So if you were my friend and you did that, and you know that I did this, at the end of that first year, you're giving me all kinds of you know what, and you're telling me I need to go talk to your guy because my guy sucks until next year. Lost 20%. It's not 20 of 100, it's 20 of 130. So it's $26,000. So this is now down to 104. Now the same 5%, we're at 109,200. So that is a 67% difference in gains just in 3 years. And most people that I know would rather have this than that at the end of 3 years, right? Now, there's another thing going on here. I told you I'm from Kentucky, and people think we're a little slow. But somewhere back in grade school, I think, I learned that 9 divided by 3, as we say in Kentucky, ain't 5. It's 3. So if you're using the 4% rule of distribution in retirement, and this continues to happen to you year after year after year, where you get ups and downs and ups, and you're pulling money out, and you're basing it on like a 5% flat rate of return, but you're only going to get 3, what's going to happen to your retirement plan? It's going to blow up in your face. That's what's going to happen. The 4% rule, would it work here? Nope, it does not. Be really, really careful when these people on the internet, the CNBC talking heads, books. I've read lots and lots of books that they say this is the rule of retirement. I would promise you most of those people are absolutely wrong because they don't live in the real world. So be really careful about this stuff. So keep on going here. Income planning. This is a thing that most people don't have. I'm not sure how people go into and through retirement without one, because it's how we manage people's retirement plans. But people do this all the time. Now, does anybody remember these things? Triptychs, yes? Well, for those of you who do not remember them, a triptych, this was back in the era before cell phones, before GPSs. Back in a day, if you were going to go on a trip in a car, you had to have a map, right? Remember maps, all atlases and things? And so if you were lucky enough to be a member of AAA, my family was too poor. I grew up in a small town on the wrong side of the tracks in Kentucky, and we could not afford AAA. Had friends who I saw these things, but you could call AAA and say, hey, I'm going from here to, let's say, Dallas, Texas. Never been there before. I'm going to drive. I need a triptych. So a couple of days later, this thing will show up in the mail. What it is a paper GPS. It will, if you flip through it, it'll say, go down this road so many miles, take a left. Oh, by the way, there's a great restaurant on the right, and there's a site down here you might want to stop and see on the left, and keep on going because there's a great motel down here. It was like a GPS system. It was a road map. A retirement income plan is the same thing. It's a road map. It helps you not guess. Because what people do, unfortunately, they retire, they start spending money. They're probably spending more money in the first few years of their retirement doing the things they want to do, but they don't know how spending that money is going to affect them when they're in their 80s and 90s, because they're just guessing. So I don't guess. You shouldn't either. So, because this is just a fact. This is the retirement mountain. When you're climbing that mountain and saving for retirement, it's really a lot easier. You probably put it on automatic pilot, a lot of it, because you probably had a 401k plan or something, and you said, take this much money out of my paycheck, put it in my 401k. You probably got a match to that of some sort, and it just happened every paycheck. It just happened, and you didn't have to do much to make it happen. So it was pretty easy. When you get on the other side of this and you're managing your retirement, income and retirement and everything else, you're facing stuff that you've never faced before, nobody's ever educated you on, and some of this stuff gets pretty complicated. So we've talked about one thing, sequence of return risk. There should be things that are simple. When and how to take your Social Security. That's a tough one. So Social Security Office tells us about 80% of us screw it up every single year. We don't maximize it. We leave money in the system. What about Medicare? Which Medicare plan should you take? What makes the most sense? It's basically a one-time decision. If you screw it up one time, you might screw it up forever. What about taxes? If you have a lot of tax-deferred monies, for example, in 401ks and IRAs and 403bs and 401as and TSPs, all that stuff is tax-deferred monies. Anybody here think taxes are going to go down in your lifetime? Please raise your hand, and I will buy you if you can prove it to me, I'll buy you the best anything you want, because nobody can prove it to me. I've asked this question to thousands of people over 18 years. Nobody's ever raised their hand. We all know taxes are going to go down. So ask yourself this question. If you've got tax-deferred monies, which is 100% taxable, and they raise taxes, we all said taxes are going to go up, you're going to get a pay cut. They're going to take more of what you saved your whole life for. Why don't you do some tax planning right now? You should, before taxes go up. That's a really important point. It's just all these things. What about inflation? Have you ever considered inflation, that inflation is actually different for different expenses? If you just take one inflation rate and put it on your expenses, and you dump all your expenses in a bucket, your plan's not going to work. It's going to be a deficit because certain things go higher and lower with inflation. Healthcare costs. Bridging. If you're going to retire early, how are you going to get your healthcare covered until you can get on Medicare? Long-term care solutions. We'll talk about that in a minute. A lot of people don't look at that. 70% of all retirement plans that fail are because of uncovered health care risks. All these questions that nobody ever taught you about. So, income. There's only 3 types of guaranteed income. I like guaranteed income. Anybody here have a pension? Few people? Yeah, I don't. I'd like to have one. Most of my clients don't have them either. Only 8% of Americans have them anymore. That's mostly public employees and people who work for unions that is part of their union contract. Most major corporations don't offer them anymore. It's a shame because as early as the early 80s, or as recently as the early 80s, 70% plus of Americans had pension plans. So how do we go from 70+ % in the early 80s to 8% today? What happened? 401k plans and 401as and Bs. So, anybody wonder where matches came from in your 401k plan? Why would they give you free money? Well, it came because pension plans in the United States before in the 80s were totally underwater. They were illiquid, and the companies had to put their earnings into them to fund them. That was the law. So it was keeping returns, the price of stock down. And so what they did, they finally figured out, well, if we could get people to move their money from their pension plan over to this 401k plan thing, that would be great. And we wouldn't have to put our money over here and our stock prices would go up. How did they do that? It was a match. My first match in 1982, I went to work for the largest law firm in Tennessee in Nashville. They had a pension plan. My first match was 22%. I knew people that were in the 30s because they were getting rid of the pension plans and moving to a 401k. Within 9 months of me joining the firm, they closed their pension plan. That happened all over the country. It's one of the reasons we have a crisis in this country about retirement right now. And believe me, we have a retirement crisis here. So that's, unfortunately, not enough of us have these. So Social Security, love Social Security. The problem is it's not enough money. $1,450 on average. Around here, it's about $1,900. It's a great benefit. It has all of these things and plus a whole lot more. So I'm going to hit these highlights here because a lot of people are interested in this. Spousal benefits. If you're married, and let's say that your Social Security is less than half of your spouse's, you can get an add-on to your Social Security to equal half your spouse's without hurting your spouse. That's a good thing. Divorce spouse benefits. If you were married to anybody for 10 years or longer, and you're not married to them anymore, but your Social Security is less than half of theirs, you can file and get the add-on of half their Social Security, just like you used to be married to them, but you don't have to put up with their BS anymore. You can do that. Survivor benefits. So if let's say the higher earning spouse and the higher earning Social Security benefit dies, the lower earning spouse gets to take over the higher earning spouse Social Security as of the date of death. That's a great thing. Here's a planning point. I bet you haven't thought about this. And ladies, this is primarily a female problem because we die first. Over 80% of the time, guys die before their wives. So guess what? Have you ever thought about that the survivor, which is usually the wife, is going to lose a guaranteed lifetime income stream? Because they're going to lose their Social Security. Whatever they were getting, they will lose that. Then ask yourself, how do you replace that for the survivor? With cost of living adjustments on it. I bet you hadn't thought about that one. You should. All this stuff's real. Now, this is an interesting one. Survivor benefits. Divorce survivor benefits. So I give you, the best way to give you this one is by example. I had a client, he's gone now. He was a massive high earner his whole working career. Married 4 times in his lifetime. He was married when he died. 3 ex-spouses, all 10-year marriages, all not married when he died. And they all had much lower Social Securities than his. So his current spouse, though his widow, of course, got his Social Security benefit. Big, high Social Security benefit. The other 3 ex-spouses also got his Social Security benefit. 4 spouses, 1 current and 3 ex, getting massive Social Security benefits on 1 Social Security earning record. About here, a lot of people say, well, no wonder Social Security is in trouble, we're doing things like that, but that is how it works. So if you know anybody like that, you might want to tell them about it. 81 different ways to maximize your Social Security. This is what the Social Security Office reports has been saying for almost 19 years, that about 80% of us file incorrectly when we file for Social Security, and we're not maximizing the benefits because most people don't know about it. Best age for you to start. So if you ever come and see me, I can tell you when the best age for you to start after we have a discussion and we run some numbers for you. But I promise you, nobody on the internet can tell you when the best age is to start. Your CPA is not going to be any help either. Your dentist isn't going to be any help. Your brother Andy's not going to be any help. Your best friend's not going to be any help unless they do 2 things. 1, they run for you based off your information a Social Security maximization report, a validated Social Security maximization report that shows you all of your different options. Then they build a retirement income plan for you, and they test all the different options inside your income plan to see which one works best for you. And unless they do that, you're just guessing in most cases. So I would tell you, don't do that. Work rule before your full retirement age. People's full retirement ages now are 66 and 10 months or 67. And if you try to file for your social before that time, and you're still going to work, right now, this year you can make about $24,000. And then every $2 above that, they'll take $1 of your benefit away from you. So you can't make that much money and get all of your Social Security benefits before your full retirement age. Once you reach full retirement age, you can make $100 million a year and get all your Social Security. That's not a problem. Taxation of Social Security. Boy, there's people getting this one wrong. A lot of talk about this. There was a lot of talk about this in the election. There's been a lot of talk about this after the election. Is Social Security benefits are now not taxable. Not for my clients. There's a little bit of truth to that, or some truth to that. They created a $6,000 additional deduction for people 65 and older that lasts for 4 years, that goes on top of your standard deduction. So if you're married, both of you get $6,000 on top of your standard deduction. That's a good deal. So who does that help? Who does that really help not pay taxes on their Social Security? People who don't have many assets and don't have much other income. But we're breaking the thresholds. So guess what? It is going to help a lot of people in this country. If you've saved some decent money, not even a massive amount, but some decent money, and you've got other income and stuff, what that $6,000, the more income you make, it goes down, and then it eliminates, and you're probably not going to get it. So your Social Security, up to 85% of it is potentially taxable. So don't let that happen to you. You can keep that in most cases, you can keep that from happening. And then possible reduction. Social Security Office has been telling us this for 17, 18 years in their annual report. They say, if something's not done to fix the Social Security system by around 2033, they're going to have to reduce everybody's benefit by 21%. Now, I don't know if they're going to do it or not, okay? But I will tell you, in your income planning, you should, about here, because we do, take 21% of both your Social Securities if you're married out and see how it's going to impact you. And then ask yourself, if it happens, how are you going to replace that guaranteed lifetime income stream with cost of living adjustments for the rest of your life? Because nobody I've ever met's ever thought about that one either, because all of this is just true, but it is a fabulous benefit. Now, if you ever come and see us, so we were going to run this maximization report to you. I'm going to give it to you. I'd give it to everybody. This is the best maximization report in the world, but you can't buy it. It's not available retail. So what I do is I run the report, I show it how to read it, and I give it to everybody who comes and sees us, free of charge. If you ever come and see us, I'll at least do that for you. So the only other guaranteed lifetime income can be created by annuities. So when I get here, this is what I hear. Oh, I hate annuities. I hear, oh, I love annuities. I've been doing this 18 years. And I can tell you, even people who own annuities, one, I ask them a first question, what kind of annuity do you own? About 99% of them can't tell me, because there's different kinds of annuities, different types. If they do, then I'll say, do you know how it works? Do you know in 18 years, I've never met anybody that knows how their annuity works. I've seen thousands and thousands of annuities that people have brought into us. And then the next question, it really is, and how does that annuity fit into your retirement plan? How does it really benefit? What's it really going to do for you? People can't answer that question either. So annuities can be good tools, but people buy the wrong ones at the wrong times for the wrong reasons. So I do a little education about them because you already own one. You can tell me, you're just like Ken Fisher at Fisher Investments. I hate annuities and so should you. I can tell you Ken Fisher gets his Social Security now because he's at that age. He does not hate Social Security. And you won't hate your Social Security either. If you're already getting it, I guarantee you don't hate it. It is the world's largest annuity. The word annuity just means the thing that qualifies to be an annuity it does not have to, but it can create a guaranteed lifetime income stream for you. So if your pension plans, people had some pension plans, that's an annuity. It's being paid by a life insurance company. They gave you the pot of money when you decided to take the income stream option to a life insurance company, and the life insurance company made a promise to pay you that as long as you're alive. No, people don't hate like I said, I'd like to have a pension plan. Lottery winners. If you win one of those great big lotteries and you take the best tax option payout, you're going to take a lifetime annuity payout. That's what you're going to do. And then if Frank Azar, you know that dude that's on every billboard around Colorado? He's on billboards out in the middle of nowhere in southern Colorado. If he wins you a big legal settlement because one of those big trucks runs over you that he's always talking about, you're going to get a lifetime payout. It's an annuity. So the word annuity is not a bad word. It's just, it is what it is. So there's one type of annuity that's it should have gotten a lot of play long before this, but it's starting to get a lot of interest. It's called a fixed index annuity. So this research paper came out in 22, AllianceBernstein. AllianceBernstein is the fourth largest financial firm in the world. And then the next year, BlackRock, the largest financial firm by multitudes over any other firm in the world, came out basically with the same paper. They were both I believe they plagiarized a 2018 article by Dr. Roger Ibbotson, who's the guru of Wall Street, that he talked about this. If you read these, what they're talking about with a fixed index annuity, they talk about them with having you can't lose money, reasonable gains, you can do them with no fees and expenses. But what they're really talking about here is using them as a bond alternative, because you shouldn't have bonds in your portfolios for the next 20 years. Why? Because interest rates run in 30-year cycles. The top of the last cycle was 1982. The bottom was 2012. Just think what happened. Interest rates in 1982 were really, really high. 10-year Treasury bonds are paying 16%. Went down 2012. 10-year Treasury bonds are paying nothing. CDs are paying nothing. Laid down there for a while, and then guess what happened? Rates started going up. 30-year up cycle. Every 1% increase in interest is 10% loss in value in bonds and bond portfolios. That's what they're talking about, because their investors are ticked off because the bond portion of their portfolios have been losing money for the last 8 years, and they're going to keep on losing money. So, a fixed index annuity is a good bond alternative. So, there are only 3 types of annuities. So, there's different flavors of each one of these, but there are only really 3 types. There's a fixed annuity, a fixed index annuity, and a variable annuity. So, fixed index annuity, we use them. They're like a CD. They're issued by life insurance companies, but they pay a higher rate, a higher interest rate than any CD or what your bank will pay you. So if I've got a client, let's say around here, that's selling a house, they're going to go, let's say, to Europe for a couple years, spend their couple years over there doing the immersion thing. Well, one, they're going to have to buy a house when they come back. So they don't want to put the money in the stock market because they don't want to lose it, but they want more interest than their bank's going to give them. So we'll use those maybe for while they're gone for 2 years. There's no fees and expenses in them. They'll come back, they'll take the money with the gains and go buy their house. That's how you use them. That's how we use them if we're going to use them. A fixed index annuity, that's what AllianceBernstein and BlackRock's talking about. Number one, fixed index annuity, you can't lose money. Guaranteed, can't lose money. Number two, you can link the gains for that annuity to stock market indexes like the S&P 500, the Dow, the NASDAQ, and a whole bunch more of them. So my little example of how they work is if you put money into one in year one and you said, I want to link it to the S&P 500. And so in year one, the S&P 500 goes up 10%. You're not going to get 10%. You got a zero floor. You can't lose any money. But with a good growth annuity, you'll get 7 to 8.5. It's not bad for no risk. Next year, year two, S&P 500 goes down 30%. So you can't lose your original principal. That's a good thing. The gains you got in the first year get locked into your principal. You can't lose any of those either. So for the second year, you're going to get a zero because everybody was in the stock market lost 30%, at least in the S&P 500. Now the third year, this is something even people that really tout these a lot, they don't talk about this, and I don't understand why, because I think this is a really good feature. In the third year, remember the S&P's down 30%. You get to do what's called a reset. So you get to reset where that index is, the S&P 500 index, when it's lost 30%. And so it's going to have to gain 43% to get the people that were in it, invested in the S&P 500, just back to even from a 30% loss. That's just the math. So all the time it's gaining, it's just regaining losses for people in the S&P 500. That annuity gets to reset down here, and all the time it's regaining losses, the person that owns the annuity is actually making money. So I think it's a really cool feature for them, but nobody talks about it. Now you can also do them with no fees and expenses. That's how I usually do them. The other thing is you can create guaranteed lifetime income with them. Absolutely can. And you can do it, and this is a really great feature too if you're going to use them this way. You can do it with not annuitizing the money. So annuitization is usually best understood by people that have pension plans. So most pension plans, not all, but most pension plans have 2 options. You can elect a guaranteed lifetime income stream. You can put your spouse on there if you'd like, or you can take a lump sum. You can do one of the two. If you opt for the guaranteed lifetime income stream, let's say for you and your spouse, you give up the bucket of money. That goes to the insurance company. They give you a promise, we will pay you that income until the second one of you dies, okay? So what happens in the third year you're retired, both you and your spouse are killed in a car accident. What happens to that income stream? It's gone. Because the other flip side of the coin is the insurance company promised you to pay you till you're 150. The money, so your money that you have is gone. Your kids don't get it, right? That's annuitization, okay? I don't like annuitization. So again, a fixed index annuity can do a guaranteed lifetime income stream for you and your spouse if you want to. And if you die in the third year in that car accident, what's ever left, going to go to whoever you want to go to, your kids, your church, doesn't matter. If you live to be 150 years old, you're going to get an income stream for 150 years. And then when you die, whatever's left over, if there's anything left over, will go to your kids or whoever you want it to go to. So that's how a fixed index annuity works. Variable annuities. These are the ones Ken Fisher talks about. Fisher Investments, all over the internet, on the TV. I hate annuities and so should you. Talking about variable annuities. I don't like them either. I don't use them, but they are what they are. The reasons I don't like them, one, the money inside of them is put into a closed-end mutual fund. So I don't like mutual funds necessarily either, but if you're going to buy mutual funds, just go buy the mutual funds. Don't buy them inside of a wrapper in a variable annuity, because if you do, the average fees and expenses in a variable annuity are 3.25% per year. Most people will add 2 to 4 benefits to it that will take the fees and expenses of the variable annuity to over 5%. You can't make any money paying somebody 5% plus every year as long as you own it, especially when you're can lose money inside that wrapper. Now, the only saving grace, in my opinion, if you want to look at it this way, they can create guaranteed lifetime income streams. However, to do it, 85% of them will annuitize the money to do it. So my little example, you do that, year 3, you and your spouse are killed in a car accident, no more money. So I don't like annuitization for those reasons. So that's kind of the world of annuities, and I think everybody should know that. Now, we're going to go talk about something a lot more interesting. So anybody here have a written bucket list besides me? Nobody? Oh my goodness. So if you ever come and see me, or us, I'm going to give you complimentary my bucket list book. It is the best bucket list book you've ever. I did not create this one. My staff did. They did a fabulous job with it. It gives all kinds of ideas and just how you think about bucket lists and what you learned and all this kind of stuff. It's just a great book. My clients fill these suckers up. If you ever come, I'm going to give you, because you should have a bucket list. So if you don't have a written one, you got one in your head. Things you want to do when you retire, before you die, right? So if you break it down, what you're going to figure out, there's big things on that list, there's medium things on that list, there's smaller things on that list. So my suggestion to you, if you're like most of my clients, trips, big trips are on the top of their bucket list when they retire. If you want to do that, and if those big trips are going to Europe or South America or the Pacific or wherever, if you've ever been there, you know those places are really not hospitable. I won't say they don't like people. They're not hospitable to people with wheelchairs, walkers, and canes, right? So do that early, your big bucket list stuff in the first part. I call those first 5 to 8 years, can be maybe 10 for most people, your go-go years. Go, do your bigger stuff. Now, at some point, you either won't want to or won't be able to do the big things anymore, but you're not dead. So you're going to start maybe doing some middle things. So you're doing, that might be like local travel or things like that. So you're going to do that. That's probably going to be another 5 to 8 years of your retirement. I call those your slow go years. You're slowing down. You're just not going to great big trips and big things anymore. But eventually, every single one of us will get here. The only place we're going is to the doctor. That's your no-go years. Okay? So think through this, and all of this stuff fits together. Your income plan has to feed this. So the bigger stuff on your list is going to cost you more money. So you need to front end load the income for those years. And my also suggestion is take care of your potential long-term care risk now, not later. Because if you do that, then you don't have to worry about the money you're spending because you already got your care taken care of. So again, if you ever come and see us, we build custom tailored to you, your situation, retirement income plans, the likes of which you will never see again. Because there's very, very, very few firms in this country that do what we do. And so it'll show you your good points, your gray areas, your bad areas. We'll put it up on our TV screens. We'll play with it to your heart's content. All kinds of ways you want to do it. And it'll show you things that you have not thought of yet, because it always does. And we will tell you these are the things we see, and this is what we do to fix it, if you'd like to fix it. Healthcare. Most of us is Medicare, right? So Medicare, original Medicare, Medicare Advantage. That's it. So A and B from the government if you're doing original Medicare, a drug plan Part D, and a supplemental plan, Medigap insurance, because A and B doesn't cover everything. Or you're going to do a Medicare Advantage plan. Think it's a managed care policy. Think Kaiser, although United Healthcare, Anthem, and the rest of the big carriers also have Advantage plans, but it's a managed care policy. So I don't know you, so I can't tell you which one you might be thinking about doing, but I'll give you some advice. If you're somebody going into retirement and you want to control as much of your health care as you possibly can, okay, you're probably going to do original Medicare. You want to be able to go to the Mayo Clinic when you want to go to the Mayo Clinic and you don't want anybody telling you can't. Okay, you don't want some managed care company not being able to negotiate with the doctors that you love and you're older and they kick them off an approved list. Well, original Medicare, you don't got to worry about that. Now, original Medicare is more expensive going in than Medicare Advantage. So if the cost is your number one thing, you're probably going to look at an Advantage plan pretty hard. So the one thing I will tell you with Advantage plans is this: we got some great Advantage plans in this part of the country. But the one thing just be aware of: if you get really sick with an Advantage plan, they'll move you to what's called catastrophic care coverage, and then you're going to find deductibles and copays you didn't know about. That's come out of your pocket. Some things won't be covered. That'll be coming out of your pocket too, and it'll become more expensive than if you'd just been on original Medicare in the first place. So that's kind of how it works. Now, these are a bunch of things Medicare does not cover, but I want to get the one right here. Long-term care. Please do not get this confused with Medicaid. Medicaid will cover some long-term care. However, you got to be basically broke to get Medicaid. So if you're not going to be broke, then don't think about it, because Medicare doesn't cover 1 penny of long-term care expense. Not 1 penny. Just remember that. So now this is the best advice I can give you about Medicare. Get yourself a Medicare broker. Medicare brokers don't cost you anything. They're with you the year that you make the decision. Then they're with you every year thereafter during open enrollments, October 15th to December 7th, because you might find that you need to make some changes along the way to keep coverage, to make sure people aren't ripping you off from a cost perspective. A good Medicare broker will be there every step of the way. Now, the other piece of advice I give you about a Medicare broker, I suggest you get a young one. Get it? Because you want them along the way, right? Okay. So, long-term care risk. So I get here and people do this. They jump immediately to a nursing home. That's what a lot of people do. Long-term care. I'm not going to get that. I don't want to go to a nursing home. So that is really bad thinking. If you make it to 65 and you live to life expectancy, 70% of us are going to need long-term care of some type. There's home care, assisted living facility care, nursing home care, and memory care. Of that 70%, these are today's statistics, only 7% will ever see the inside of a nursing home or a memory care facility as a resident. 93% of care today is delivered in the home, 72%, and assisted living facilities. And those percentages are going up because of technology. About 5 years ago, only 50% of care was delivered in the home, was capable of being delivered in the home. Same thing with long-term care facilities. They're keeping people longer. And so those percentages are going up, so necessarily nursing home percentages and memory care percentages are actually going down. So I think of this as anti-nursing home coverage, risk coverage. So there are 9 ways to cover this risk. Most people think there's one. The 9th one on my list is traditional long-term care insurance. We can write it. We have not written a traditional long-term care insurance policy in over 13 years because there's 8 better ways to cover it now. I can cover it in such a way that it's low cost. I can even get it covered so it's no cost in many, many circumstances. I can get it in, so that a lot of people say, well, if I put all that money over there and I never use it, I've lost all that money. I can get the risk covered where if you never use it, more than you put into it goes back to your family, all tax-free. And then if people can't get it because of medical conditions, usually that's what they want, number one in their life. Boy, they sure would like to have it covered. I can get the risk covered without one medical question asked, ever. So I suggest you at least look at this, because this is what blows up 70% of retirement plans, the not coverage of it. So taxes, oh, this is my favorite. Anybody work for the IRS? I got 6 clients that do. I've done all their tax planning. So most people look at, and this is professionals too, CPAs, tax preparers, enrolled IRS agents, they look at taxes in a micro perspective. This year, maybe a little bit next year. I work with a lot of CPAs. CPAs are historians. They were never taught to do macro tax planning the rest of your life. So you take them the stuff from last year, you give it to them, they prepare your taxes for last year. That's just, they might tell you something next year, but they don't have enough information to do lifetime planning. So unless you meet somebody like my firm, you're probably not going to get it done. So, because financial people don't do it, ask them. Go ask one of the big firms, say, hey, I need to do tax planning. They'll tell you, oh, you need to go talk to your CPA. Ask your CPA, you need to do macro tax planning the rest of your life. They'll tell you to go talk to your financial advisor. It's a circle. I see it like every single day. Not many people do macro planning. So we all said taxes are going to go up, and this is why, we all know this. Lots and lots and lots. This stuff just gets worse, it's not getting better. So there was a really famous judge back in the 30s and 40s. His name was Learned Hand. He's the philosopher judge of our country. You've probably never heard of him. Lawyers have heard of him. He's been quoted more times by the U.S. Supreme Court and U.S. appellate courts than many, many more times than any one person in history. He said this in 1938, and it's still true today. There are 2 systems of taxation in this country, one for the informed, one for the uninformed. So, have you ever wondered why really wealthy people don't pay that much in taxes? Because they know somebody like me. It's just the truth. And then if you stay uninformed, you're going to pay taxes. And every time that you pay more taxes, as taxes go up, you're getting less money that you get to spend, and you get to leave to families, friends, whoever, charities and stuff like that. I tell you, you need to think about doing tax planning. Because if you don't, you're going to stand in front of my friend here and he's going to run you over in retirement. Now I got a little example I show. It's just one little example, but it starts getting the point across, I think, to people. So this example is we use a $500,000 IRA account. The person is 64 years old right here, and they're going to get their RMDs at 73. RMDs, required minimum distributions. It's either 73, depending on the year you were born, or 75. You have to start pulling money out of that tax-deferred monies, IRAs, 401ks, all those, and start paying taxes on it. It starts the first year at a little less than 4%. That percentage goes up every year for the rest of your life. From 73 to 80, you're over 5%. When you're in your 90s, you're in double digits of pull out and paying taxes on that. Those are called required minimum distributions. So if this person lives till 90 and they start their RMDs at 73 and their account grows at 5% a year, the taxes, just the taxes on the RMDs to age 90 that they'll have to pay $204,000 plus, just the taxes. Then they'll take what's left over and they'll probably invest it. That's what we're assuming. And they invest it like in a brokerage account where it's taxed on an annual basis. They'll pay taxes on that secondary account of $96,000 on the gains. And then at age 90, they're going to die, and their relatives are going to pay $156,000 in taxes. And this assumes taxes do not go up. This assumes taxes stay at the current level through this person's age 90. So this is the most positive look at taxes for this person in this account that you can have. So on a $500,000 IRA, they're going to pay $456,000 in taxes, them and their family. To me, that's nuts. But that's just what people do every day. So if you just did this, so if you converted that money over to a Roth IRA. So a Roth IRA, you probably know, once you get it over to the Roth IRA, it grows tax-free. okay? But you got to pay the taxes to get there. So if you converted this IRA, $500,000, just over a 4-year period, and you paid taxes on it, you're going to pay $125,000 in taxes. But all of the gains for the rest of your life are tax-free. And then when your kids or whoever inherits the money, they're not going to pay any taxes on it either. So in this example, they're going to pay $125,000. They're going to do one or the other. Most people are going to do the one on the left, and that's going to go up, and they're going to have less because taxes are going to go up. We all said that. And these are just the numbers. Now, the other thing is, I would recommend not leaving a lot of tax-deferred monies to your children or anybody you care about. If you don't know this, since 2019, they have to take that money out over a 10-year period and pay taxes on it. So if they do that equally over the 10-year period after you're gone, you're probably pushing their income up to higher brackets, and they're probably cussing you every April for 10 years for leaving them that tax-deferred monies. Don't do that. Leave them tax-free monies, because that won't affect them. They still have to pull the money out over 10 years because it's in a Roth IRA, but there's no taxes on it. So you're not hurting them. So now, and remember, there's side effects. Your Social Security benefits, like we talked about, are potentially taxable, especially if you've got a significant amount of IRA money, tax-deferred monies, and that money's coming out. It's probably going to make 85% of your social taxable. For an average couple, if they live to life expectancy, they're going to lose somewhere around $600,000 that's right there in Social Security over their lifetime if they just done some tax planning and not had their Social Security taxable. And now there's another bad side benefit, not doing tax planning. Medicare is now, if you don't know this, it's income adjusted. It's called IRMA adjustments. It's not Aunt Irma. It's the negative. It's the ugly Aunt Irma. If you make too much money, there are 7 categories now that Part B, for example, which this year should cost you $202.90. There are lots and lots of people paying $700 plus. That's per person if you're married. That's for the rest of your life if you don't do something about it. And so you can, just an average people, like in level 3, they'll pay twice as much on their Part B. Part D is also adjusted. And what's going to happen to them is they're going to lose about $400,000 in their lifetime if they let IRMA adjustments into their life. I suggest doing tax planning to the point where you're not having to deal with IRMA adjustments or having your Social Security taxed. So financial estate planning, then I'm going to let you eat. So I'm doing pretty good. So I get here, and most people will, or a lot of people will say, you know what? I don't have that much in assets. I don't really need an estate plan. I don't really have an estate. So I'm going to dissuade everybody in this room, I hope I am, tonight, because everybody needs an estate plan. At some level, you need an estate plan. I'm going to show you why. So if you go to an estate lawyer, you're going to get a will. Okay? If you're married, both of you will get a will. Then you're going to get a health care power of attorney. Both of you will. And so some people say, well, wait a minute. I thought we were talking about estate planning when I die. Yes, but estate planning is first about disability planning when you're not dead. So because somebody's got to be making those health care decisions for you. And then somebody's got to be making your money decisions for you. That's a durable power of attorney. So because you can't do it, you're disabled, right? Then you'll have a living will. You're still alive, but you do not resuscitate directives if you care about that kind of stuff and things like that. And then you might or might not get a revocable trust from this estate lawyer. And I will tell you, most estate lawyers will tell you this. Well, unless you have a lot of assets, you don't need a revocable trust. So let's say you listen to them and you don't have one. You got to solve all this stuff. And then you become disabled. And you name your spouse, or anybody, but your spouse is durable power of attorney over your money. You have just made your spouse a pure fiduciary, just like me and my advisors. So, as a fiduciary, they can't spend your money for themselves. They can only spend your money for you. They can't spend your money on your kids, on your grandkids, on your charities. Okay? So, my wife and I have taken care of this, but if we hadn't, since she's not here tonight, I'm going to use her as an example. She always loves this one. So my wife thinks that, and rightly so, her money's her money. She also thinks my money is her money. Okay? So I get that. My wife doesn't like keeping receipts. So if we hadn't taken care of this, my wife is going to probably spend, if I'm disabled, probably spend my money on her and our kids and our grandkids and stuff for charities. She's probably not going to keep the receipts. Well, if my disability lasts for 12 months or longer, institutions out there holding my money are going to tell her at some point, wait a minute, that durable power of attorney has gotten old. They call it being stale. And they're going to tell her, you need to go get a court order so that we can still allow you access to John's money. So she's going to have to go hire an attorney at $400 to $600 an hour. She's going to have to get all those receipts that she doesn't have. She's going to have to go to court and try to convince a judge that she did not breach her fiduciary duty to me. Now, my wife loves me, but my wife legally breached her fiduciary duty to me. The judge is going to not allow her to continue. They're going to appoint a court-appointed attorney at $400 to $600 an hour to be my durable power of attorney for as long as I live, which is probably the rest of my life. So that's going to cost my family a lot of money, and maybe some restrictions to my money that my wife wouldn't like too much. There's another thing that happens is because she had to go to court, all of my financial records had to be submitted as evidence. All of my financial records are now public records. I'm disabled. All those scammers are looking for this stuff all the time. And so guess what? They're going to get my stuff. I'm disabled, can't do anything about it. That's probably a nightmare for my family. So let's fix it. All we got to do is put a revocable trust in here. Now let's put one for each one of you if you're married. Please don't do a joint spousal trust. I see that if I see a revocable trust, it's usually a joint spousal trust. You just gave up 15 benefits that you should not have given up. And if all you had to do was have two separate trusts, not one. So don't do that. Have one for each one of you, then fund them, put things in them, balance them out. Now, let's say we did that and I named my wife my disability trustee because I can't be that anymore because I'm disabled. And my assets are in that trust. My wife can use my assets for her, my kids, my grandkids, charities, pretty much anything she wants. She doesn't have to keep any receipts. She never has to go to court. None of that stuff. None of my records will ever become public because no institution out there will ever question her powers as trustee under that trust because that trust is a separate entity under the law that has an infinite life expectancy. Nobody will ever question her powers. So I just solved a really big problem that I've seen over and over and over again for people because they don't do this kind of stuff. So now, I had you disabled. I'm going to kill you off now, okay? Most of our monies go to our kids, let's say. Anybody here have a daughter-in-law or a son-in-law you don't trust or like very much? Anybody? Oh, you're all nice people. There's always somebody. But let's say you have, and say let's say you die. And let's say you leave a big chunk of assets to that child who's married to the bum. Well, the bum, you were right, they have a Trixie, Dixie, or Lou on the side, right? They also have a divorce lawyer friend. And after you're gone, the divorce lawyer friend and the bum are sitting someplace like this having a drink at the bar, and a divorce lawyer friend who knows about Trixie, Dixie, or Lou says, hey, didn't your spouse just inherit a bunch of stuff from their parents? Yep, they did. How would you like to take half those assets and run away to Mexico with Trixie, Dixie, or Lou? Guess what? Half your assets are going with the bum to Mexico with Trixie, Dixie, or Lou because you didn't plan for it. You didn't protect for it. I call these things family wealth predators. There are a number of them. I'm only going to talk about three. Your kid's divorce, okay? I don't want my money going to somebody else. I want my money going to my kids and my grandkids. So that's a bad result. Lawsuits. Let's say you had another child. You left the other half of your money to Mr. or Mrs. Perfect Child, like my Skylar, perfect child. So they go to church every Sunday. They don't have anybody in their life. And just as they're pulling in the church parking lot one Sunday, their cell phone buzzes. They look down at it just for a split second. Next sound they hear, ba-bump, ba-bump. They just ran over the new brain surgeon in town, and this person is dead. Their family, the brain surgeon's family, is going to sue your child for everything they've got, including the money you left them. That's going to that family. I don't like that result either. Now, taxes. This is one I'm not talking about income taxes. I'm talking about estate taxes. Now, a whole lot of people have forgotten about estate taxes. Why? We have a $15 million per person exemption portable between spouses if you're married right now. Therefore, a couple can leave $30 million to anybody they choose of stuff, no estate taxes. Now, you don't want anybody paying estate taxes because right now it's one of the lowest rates. It's about 40%. The average is 68. I'm pretty sure that's where we're headed. So that's why people forgot about it. Well, maybe you shouldn't forget about this. Number one, there are 3 bills pending in Congress right now that embedded inside of the bills take the exemption back to $3.5 million. That's where it was before this one. Not portable between spouses. That means when one spouse dies, the other spouse doesn't get their $3.5 million. Take your house around here over the next 20 to 30 years. Your house is probably going to be worth that. If it's not already worth that, right? Then all your other assets, your kids are going to pay estate taxes on. So I believe it's going to go back to $1 million. That's where it was for 30-something years. It's what caused farm aid crisis in the middle of America, back when Willie Nelson was trying to help farmers because corporate farming had come in, and I came from a farming family. Farmers have dirt. We don't have money. And so people were taking their family farms. I truly believe it's going back to $1 million because they know they got to have money. And it's a really easy thing. They also know, they being Congress, some things that I know. One of the last things, if not the last thing, that even people who have a lot of assets ever deal with is proper estate planning. So they didn't do any proper estate tax planning. That happens all the time. And the government collects a whole bunch of money that, quite frankly, they shouldn't have collected, but they're going to, and they do. They also know that there's $180 trillion in today's dollars passing between generations over the next 20 years. And they know a lot of people don't do estate tax, don't do this kind of planning. And so their plan is to get a bunch of it from us, because we'll be dead. That is their plan. So a lot of people will say, well, it's political. So the Republican Party wants no estate taxes. The Democratic Party wants you to pay taxes on everything. Well, it used to be that way. However, I'll give you a little evidence. They all know there's a problem. They all know they need more taxes. The 2017 tax cuts that were done under the first Trump administration were scheduled to sunset December of last year. Okay? They passed the tax law last year. It extended that, so that didn't happen. However, if the 2017 tax cuts under the first Trump administration had sunset in December, it would have cut the exemption in half. That's the Republicans who are not supposed to want estate taxes. So I'm telling you, this is the kind of thing you got to keep your ears open for, because I think this is going to become a bigger problem. So let's just fix all this. Let's put a specialized irrevocable trust in place for each one of your children. Let's have all these things happen again. The divorce lawyer, the bum's got a divorce lawyer. The divorce lawyer is probably going to convince the bum that they can break my trust. It's been tried so many times, they cannot break my trust. That trust is impregnable. So your kid's going to get a divorce, but your assets are going to stay with your family for your kids and your grandkids, if they last long enough, for your great-grandkids and your great-great-grandkids. So I think that's a good result. Lawsuits. Your child's going to get sued, the one that ran over the brain surgeon. They were negligent. And they may have to go to bankruptcy court, but not even a federal bankruptcy court can break that trust. That has also been tried over and over again. So your kid's going to go through bankruptcy, but all those assets are waiting for them to use for the rest of their life. So that's a good result. And in the state of Colorado, if you do this properly, no estate taxes for 1,000 years. My guess is your assets will run out long before that ever happens. So this is just, for me, this is kind of basic estate planning. There's a whole bunch more complex estate plans. But most of my clients, this is what we end up doing with them. So you have a sheet in your folder that Emma, I think, mentioned. It is an evaluation form. It looks something like this. It's in each one of my areas, my prime areas. So it's a 1 to 10 scale but there are no sevens in it. Seven's a fence sitting number. I don't do fence sitting, okay? So, and this is an evaluation form, not of me, not of my presentation. This is an evaluation form to help you evaluate how you feel about if you have any issues on a 1 to 10 scale in each one of these areas. So for example, in my protect assets, the P, if, for example, you don't have any defense, you've just been doing buy and hold, and you're kind of concerned about what might happen if markets went down for a long time, when you're pulling money out, you might get low, you might run out of money. Those kind of concerns, if those are concerning you, you're down here. The reds mean you got bigger concerns. The green means you think you're doing pretty good. So just rate yourself. Retirement income, if you don't have a retirement income plan, you're down here in the reds. If you've got a retirement income plan, that's great. I've never seen one that's in the greens, really. But if you do, come show it to me. I'd love to see it. Integrated health care. If you don't really know much about Medicare, if you need help, you need a broker. Long-term care solutions, if that's something that you think you might want to look at. If you don't have those type of things, again, you're down in the reds. If you've got all that covered, you're up in the greens. Taxes, if you've got some tax concerns, if you've got a lot of tax deferred monies, I can promise you have tax concerns. But there's more tax concerns than that. Capital gains, if you own real estate, and you got a lot, that stuff's gone up and up and up, and you might want to not be a landlord anymore in retirement, but you really don't want to pay all the taxes if you sell it. I have ways that you don't have to do that. Stock, highly appreciated stock, old stock that's really kept on going up and up. It's capital gains. I have ways that you don't have to pay the capital gains taxes. So those are just issues, but you should come and see us. If you've got all that covered and don't have any tax issues, great for you, but you're unusual, I would say. And estate planning. If you've got an estate plan that's covered the areas or need to be covered in the areas that I talk about, that is wonderful. If you don't, and you'd like to have that kind of estate plan, you're down in the reds. That's kind of where you're at. So if you will, fill that out. If you'd like to come see us at the bottom, it says circle this time. Cassie from my office, who's a wonderful young lady, will call you and set a time for you to come see us. If you don't want to come see us, just circle that. I don't have any concerns. Nobody's going to call you. Nobody's going to bother you. But you should fill it out and note anyway and give it to Emma, because we're going to give away a $50 gift certificate back here, and your entry is that sheet of paper. So give it back to Emma. I promise you, if you don't ever want to hear from us again, well, you might want to come back and buy you a dinner or something, but that's what you should do. All right. So I've tried to answer this question. I've tried to show you how we answer this question for our clients with certainty in all the different areas that their retirement really needs to address. Oh, this is my team. It's a little bigger now. We built some bicycles for some kids that needed bikes back during Christmas time. So that's kind of us. The last thing I always address is, because my wife gets upset if I forget about it, is how do we get paid? We do a lot of stuff for people before we ever consider whether they should be a client or whether they ever just decide to become a client. We get paid 3 ways. One, we're a pure fiduciary. We have our own investment portfolios. They are ultra high net worth portfolios. They're portfolios you've never seen, probably never see again. But those portfolios it's an asset management fee. We cannot charge you, because we're pure fiduciaries, for the buying and selling of securities. You shouldn't want that anyway. Our pocketbooks are tied to your pocketbook. You do good, we do good. That is how it works. We also do things that are not connected to the stock market. I don't believe in putting all my clients' eggs in one basket. So we use things that are alternative to the stock market, so that when the stock market has problems, maybe has some losses, this side doesn't, and there we can balance that out, and we don't have to recover so much. All of those things, we got a bunch of them, are all commission-based from the companies. You do not pay that. So that's how we work. So we get paid asset management fee under the things that are in the investment side. We get paid commissions from the companies from the things that are commissionable. Nobody ever writes this firm a check. Nobody has ever written this firm a check in 18 years. It's not how we do it. My third way is, and it's the best way, we get most of our new clients from our current clients. And we have lots of events. Almost all of them, they're either fun or educational. And we just have clients say, hey, bring your friends and family. We're not going to do business. We're going to do this kind of presentation. We just get to know people. That's it. And usually what happens is it works really well. And we just get to know their friends and family, and then we end up we talk to a lot of them eventually, and they eventually become clients. But that's the best way for us when that's how we feel like we get paid. So hopefully you learned something tonight. If the only thing I did was make you think a little differently about one or two areas, then I've accomplished my task tonight. But I hope we'll see you sometime. Let's see, anything else I need to do? I don't think so. We're going to let you eat now. If you've never been here before, the food here is fabulous. The chef here is really great.